Coming out of World War II, we entered a global system that has often been referred to as the Pax Americana. And under that Pax Americana, we have seen a lot of global stability that was built around such institutions as NATO, the IMF, as well as the United Nations, for example. But all of that clearly happened under the leadership of the United States as the hegemon. Initially, this Pax Americana, this international order, happened outside of the Soviet bloc. But with the dissolution of the Soviet Union in the early 90s, it became a truly global order for a couple of decades. The historian Francis Fukuyama prematurely wrote a book where he called it the end of history. Now, I think it is quite obvious that there's been a rupture to this Pax Americana, to this international order, and we're moving from something that has historically been referred to as liberalism as a geopolitical system to something more closely resembling realism. And the Athenian Thucydides, 2,500 years ago, had a pretty apt description of realism. He referred to the strong take what they can and the weak suffer as they must. Now, at First Eagle, we think a lot about the top-down, we worry a lot top-down, but at the end of the day, we invest bottom-up, one business at a time. And the question we pose ourselves is, what ought one to do? What is one to do in this changing environment? So I've come to a few conclusions. One, selectivity really matters. You want to own a collection of resilient businesses that can weather the inevitable storms. Two, diversification, especially geographic diversification, matters in this more multipolar geopolitical order. And third, a potential hedge in the form of gold seems to be very timely. Now let me touch on gold. Gold obviously has done very well, but I would posit that a lot of the recent performance in gold really stems from gold reclaiming its natural role as a neutral reserve asset. We've actually been net sellers of gold, simply as we try to keep our aggregate gold exposure below the self-imposed 15% upper bound, as we continue to hold gold as a potential hedge, and we do not want to make a directional bet on gold. When I look at the gold miners in our portfolios, they have performed very well in sympathy with the metal. However, when I put the current gold price into the financial models of our gold miners today, it still seems as if equity markets are not willing to fully ascribe the current gold price to these gold miners. Another way to think about this is that a lot of the gold miners we own today still trade at close to 10% free cash flow yields. Japan, after the collapse of the real estate bubble and the stock market bubble in the early 90s, entered a period of prolonged deflation. The reason for the deflation was the financial sector as well as the corporate sector was very busy repairing their balance sheets. That led to a shortfall in aggregate demand. Now, for the first time in 3 decades, wages in Japan are actually growing, and they're having a little bit of inflation. It's nothing major. The CPI is increasing at around 2%. Nevertheless, it's a big change to what had become the status quo in Japan. And the yields, especially the yields towards the long end of the curve, have started to react. The yield on the 30-year JGB is the highest it's been in over 3 decades. And Japan is also a very indebted country, a very indebted economy. So the danger here is that some of that debt has to be rolled at higher yields, which can be problematic. Let me make a couple of observations though. One, the debt in Japan is largely owed internally. Japanese households have a very high propensity to save, and they have accumulated a lot of household wealth. So I sometimes think the better analysis for Japan is actually debt minus household wealth relative to GDP. And the reason I'm saying that is that a lot of that household wealth will be transferred to the government via inheritance taxes, as the demographics in Japan are aging rapidly. The second observation I would make is that these higher yields, these higher interest rates are actually quite attractive for the financial sector in Japan. Japanese banks, Japanese insurance companies can start to repatriate some of the capital they have parked abroad in search for higher yields. And then third and lastly, most important for us as bottom-up stock pickers, when I look at our Japanese exposure, our Japanese companies, they tend to have fortress balance sheets. What I mean with that is they have a lot of net cash on their balance sheets, and in an environment of higher yields, they're finally able to earn some interest, to earn some returns on these ample cash balances.